When trading with cash in a brokerage account, it might not be obvious when you'll have full access to the cash after selling an asset, or when you could use those proceeds to place other trades. A mistake there can leave you with restrictions on your account. So let's talk about how to avoid it. Let's say you sell $5,000 worth of stock, but when you look at your funds available to withdraw section, the balance hasn't been updated. What's going on? When you buy or sell an equity like a stock or an ETF, the date of transaction, or when your order is filled, isn't the same date as what's called the settlement date. This is when the buyer gets the shares and the seller gets the money. In fact, it takes one trading day for equity trades to settle, or T+1. This means if you sold a stock on Monday, you wouldn't receive the cash until Tuesday. Or if you sold your shares on Friday, you wouldn't receive the cash until the following Monday when the trade settles. It used to take several days for funds to settle in your account. Then in 2017, the U.S. Securities and Exchange Commission shortened the settlement cycle from 3 days down to 2. This was known as T+2, or the day of the trade plus 2 days. As of May 2024, the SEC and FINRA set the standard for cash to settle in your account as T+1, or the day of the trade plus 1. Basically, it takes your brokerage a little bit of time to catch up to your trades. Just because it's a cash account doesn't mean you can place unlimited trades. Understanding the one-day lag time between transaction and settlement can help you distinguish between settled and unsettled cash, and potentially avoid problems like good faith violations, which can limit your ability to trade. In a cash account, settled cash includes the proceeds from trades that have already settled, meaning they occurred at least one trading day prior. When you buy stock or other securities with settled cash in a cash account, there aren't any restrictions around when and how you close that position. Unsettled cash is proceeds from securities you've sold, and that cash hasn't been transferred to your account yet. However, you can still trade with unsettled cash. Let's say you had $5,000 at the beginning of the day, and you bought $3,000 worth of stock at the opening bell, and sold it at lunchtime the same day for $3,500. You might think you'd have $5,500 of tradable cash, but you'd only really have $2,000 of settled cash to trade with until the next day. You could still buy more beyond that $2,000 since the cash will settle the next day. But if you sell that before the original settles, that's known as a good faith violation. Let me break that down again. A good faith violation occurs when you sell a security, use those unsettled funds to buy another security, and then sell that security before the first sale settles. 2 warnings will be issued by your broker if you commit good faith violations. If you commit a third good faith violation within 12 months, your account will be restricted to trading with only settled cash up front for 90 days. That means you wouldn't be able to make any trades that exceed what you had available in settled cash at the start of the day. You can find out how much you have in settled funds by logging into your account at schwab.com and selecting the Balances page. Here, you'll see your funds available to trade. Under that, you'll see Cash and Cash Investments, and then Settled Funds. This does not include funds from unsettled trades, funds applied to open orders, or cash from deposits that haven't cleared yet. The easiest way to avoid any issues is to not place buy orders that exceed this amount. If you want to check your cash available for withdrawal on the Schwab mobile app, you can do that too by logging in and navigating to the Balances tab. Another way to avoid a cash settlement violation is to apply for a margin account. In a margin account, you have the flexibility to place trades with unsettled funds without incurring interest, and you don't have to worry as much about settlement dates. Margin isn't suitable for everyone though, and is not available in all account types. Margin trading increases risk of loss and includes the possibility of a forced sale if account equity drops below required levels. Regardless of which type of account you use, make sure you understand when your trades settle and monitor them closely.